3, 2, 1, live. Did I do that right? I don't know if I got it there. Well, we'll do it again. The timing, a little off. Not perfect this time. 3, 2, 1. What do they call that? That's like the clapboard, or they do in the movies. How you doing, friends? Ernie here, and this is the 0 Days to Expiration podcast, episode number 65. And today's episode, we're going to talk about the difference between different lengths of days to expiration. Of course, we're 0 days to expiration, but there is some talk out there about doing, 1 day DTE or 2 DTE or 4 DTE. Which is better? What is better? Is it better to put your trade on 4 days prior to expiration, or is it better to do it on the very last day? And why even bother? We'll also talk about the difference between entering your trade using the SPX or ES futures. Now, of course, the premise of the 0 DTE trade, or doing any kind of end of day expiration, is using a derivative of either the S&P or the NASDAQ, because those are the two indexes that have 3 expirations per week. Right? They have 3 expirations per week, which is fantastic because of the 0 DTE part that gives us this incredible edge. That's where we find alpha, in being there on that very, very last day of expiration. Of course, when you're doing 4 DTE, you're not there. You're somewhere else. You're somewhere in the distant future or past. You're not there yet. You don't know what the hell's going to happen in 4 days when you get to that 0 DTE. All right, I'm skipping ahead here a little bit. So we're going to talk about the difference between the SPX, which is the index on the S&P, and the E-mini S&P futures. A lot of people know it as the base symbol ES. Now, I had also mentioned that you can do this on NASDAQ futures and the NASDAQ index, or the NQX, I believe that's what that is, and the NQ, because they also have 3 days a week where they expire, or the option contracts on those particular assets. So which one do you use? Do you use the SPX? Do you use the E-mini S&P? Or do you use the NASDAQ? The NDX? Okay, so that's another question. It's a fundamental question, really, between indexes and futures. That's where we're really going with this. Then the next topic that we're going to take on is the fundamental difference between risk and reward. Is there a relationship between risk and reward? Do you have control over what your risk to reward is? If you take on very, very little risk or put on a high probability trade, are you absolutely forced into a certain award? Is there an inverse relationship? Is there a way to get around the inverse relationship? These are all fundamental questions. And the reason why I'm bringing all this up is that 0 DTE is an event, not necessarily a strategy. But it is an event that many traders and services have now latched onto, because it is the de rigueur day trading mantra. Because there's an air out there, there's a little birdie out there telling people that there's actually alpha there. And there absolutely is. However, approaching 0 DTE, doing it the right way, is paramount. Wrapping yourself in the old way of doing things, bringing in all your old tricks, and then trying to apply it to 0 DTE is a fatal mistake. It is a mistake that virtually every zero DTE expert or guru or whatever they want to be called out there are guilty of. And the reason why I'm bringing this up today is because I just watched a video from one of my, quote, competitors, but they're really not competitors because what they do in no way can compete with what we're doing. But one of my competitors goes by the name of Scott Stewart, has a zero DTE service. Now, his zero DTE service is very similar to all the other zero DTE services out there, like Axe Options, and this other place called Zero DTE, and Simply Options, and a few others. There's, I think, maybe a half a dozen or so of these services. All of them are doing it exactly the same way, following a very similar or exact strategy, I guess you could call it, that was made popular by this woman named Tammy Chambliss. She did a webinar, I believe, or a series of webinars touting how great this thing is. And when you join her service, you find out that what it really is a draw into you buying more of her technical analysis tools or whatever. Now, getting off track, I have just so much to say about these other services that it's just unbelievable that they actually exist and that they were able to attract people. Because, yes, there is a lot of potential alpha with trading the zero DTE event. But the strategy is absolutely critical in how you approach this. What is the alpha, or what is the edge that's available on zero DTE? Well, because we're trading options and it's on the last day of expiration, what is the one thing that is unique to options on that last day of expiration? The thing that's unique is that premium is decaying at its fastest rate, at an exponential rate, very similar to going over the event horizon into a black hole, where premium then disappears. Now, for someone who's going long an option on the zero DTE, that is a very tenuous thing. That's why a lot of people that trade long options trade way far out, like 45 DTE, so that they never have to experience the death pit of zero DTE. However, if you're a seller of options, if you, for instance, sell premium, do something like what David Jaffe does, where he sells premium, way out of the money puts, basically. And he's counting on that exponential decay right at that last moment to make essentially what is easy money, although he is putting up huge amounts of capital to make a very small amount, which happens to be the same problem that most of these other people that are doing the day trading version of zero DTE, where they're selling premium or selling options on the SPX and in some cases the E-mini S&P, trying to collect that very last day of premium that is decaying at an ever fast rate. It just like, woof, makes a lot of sense. I mean, it makes incredible sense, especially considering some of the other built-in edges that you have, that premium is, or another way of saying premium, or what's the equivalent of premium, volatility, which is the precursor to premium, is generally overstated by us humans. And when you overstate volatility, what you're actually doing is you're inflating the amount of premium that is attached to an options contract. So think of those two things, how they juxtapose one another. You're selling overpriced options on the very last day of expiration, where that overpriced component is flowing into the seller of that option. That is the edge. That is it. That is the crux. Or at least that's the attraction to most people. They see what looks like, or what could be, easy money. And it should be. if you follow some very simple steps. Now, the way most people approach this is through the traditional means. Put on very high probability trades, usually an iron condor, because they have no idea which way price is going, or they pretend that they have no idea, or don't even want to try to figure out which way price is going. And so they'll put on a very, very wide strategy that has what they call low delta spreads, which are supposedly there to give you a high probability of success. And in exchange for that high probability of success, they can potentially collect this premium that's going to expire very quickly. Now, when they put on these very high probability iron condors, which are a strategy that is primarily meant to be used in a market neutral situation, they're trying to do this 3 times a week, every week, trying to apply, now just stick with me here, trying to apply a market neutral strategy because they're scared as shit to put on any other kind of strategy, any other type of premium collection strategy, in the hopes that they will capture that and capture a tiny little bit of profit. The caveat to that is that when you put on that high probability iron condor, is that you're taking on huge, huge amounts of risk. The other problem is, and I guess this is tacit, the S&P is certainly not a neutral a neutral index or a neutral asset. It's moving all the time. It's one of the most volatile assets out there. It's going up, it's going down, it's going sideways, it's going every which way. So trying to capture the easy money with a strategy that is not designed to capture something that's moving all over the place is really a fool's errand. And so that's one of the reasons why they choose these very high probability ones. They spread it out really wide and stretched it out thin. Think of like the baker, creating a breadstick, right? And they stretch it out and they stretch it. They keep on stretching it. And the more they stretch it, the thinner it gets until it gets to a point where it just breaks. It's no longer there. And then they have to go and they have to roll it up and again and find, where's the, it just doesn't work. I don't know if that was a good analogy, but that's the one that came to mind. So what sparked this particular podcast is that I saw a video by Dave Stewart, who runs one of these zero DTE services. And he started talking about, well, is 4 DTE better than 0 DTE? And the only reason I can think, or what he describes, is that there are other opportunities when you're further out, that you're not exposed to all this risk that he imparts upon himself by putting on these iron condors. Which, by the way, he says he also has to adjust every single one of them in order to extract a tiny little bit of profit. He says that the perfect situation is where you put up $10,000 to make $1,000. In other words, his ideal situation is making 10% on his trade and putting up a huge amount of capital, and at the same time risking 70% of that capital. The reason why they're risking 70% is that they add stops in there to prevent them from losing all the capital. All right, so let's bring that down to a smaller, more manageable number. Maybe it's $1,000 to make $100. Now here's the other rub. They very rarely make that $100. What they do is they usually, if they have accumulated or collected 50% of that 10%, or 5% would be another way of saying 50% of 10%, they exit the trade very quickly because they recognize that the risk is still there as you're getting closer and closer to that expiration. Because you're in a market neutral strategy, your gamma risk is starting to go crazy and you could end up losing it all. So he characterizes his strategy as being ideal when you can collect all 10% of that money, of the risk that you put on. 10% is a good day. So before I go on, and you might say, oh, well, that sounds pretty good. You're getting 10% and it looks like easy money. Sure. But you're not really. You're really going after 5%. 5% is, the goal if you're going to get there at all. 10% is what he calls a dream, or that is like the ideal situation. Doesn't happen very often. But when they move it out to 4 DTE, they can turn that 10% into an ideal 20%. Okay, so 20% now, or half of that, which would be 10%, is now their goal with the 4 DTE. So moving out further out, they find that they can get a little bit more reward. They have to wait for it 4 times as long to get to it. So everything that I'm describing, you're thinking, oh, okay, I think I can make this work, considering my current strategies and considering that this has an edge and everything. That sounds reasonable. I can make that work, and I can probably get something over a 50%, go a few ticks above 50%. And if I do enough of these trades, I can become profitable. That's great. You can think that way until I tell you this. Our average return on a 0 DTE trade is 150% to 200%. That's our average return. We would never take a 10-to-1 risk to reward. We would never take a 1-to-1 risk to reward. We would never take a 1-to-3 risk to reward, which is already 30 times what theirs is. We wouldn't even take anything unless it's at least a 1-to-5 risk to reward. In other words, and in general, we're usually looking for a 1-to-10, where they're looking to put on $1,000 to make $100. We look to put on $100 to make $1,000. You may be thinking or rolling your eyes, but how is that possible, Ernie? How can you do that? Well, that's the whole thing. We don't stick to the normal convention of treating the strategy or the trade as a market neutral event. That is the key. Now, of course, I could go into all the particulars. You can go back and look at all my previous videos, listen to the other podcasts. You'll find out all about it, about what our methodology is. All I'm telling you is that this is the general philosophy, the general strategy of Scott Stewart, as well as every other person that's out there trying to collect premium. And even David Jaffe, who's doing a much better job, I would say, in terms of his efficiency and his efficacy of the service. However, even he is using huge amounts of capital to make a very tiny little bit of profit. Now, you may think, well, okay, that's okay. I can live with that as long as it's consistent and so forth, except for it's not consistent. When you're taking that kind of risk, that small little bit of risk, it may seem small, but that's only small when you take the entirety of the trade into consideration. If you take it all the way to expiration, that's when you realize that level of probability, maybe a 95% probability. In between there, price is going all over the place, and it's going to scare the jabeezes out of you. Is that a word? I don't know. Because almost immediately when you put that trade on, you're going to realize or be in an unrealized loss situation. Sometimes so untenable that you just have to get out. And this is one of the reasons why, for the life of me, I don't understand this. Anybody that is a seasons options trader actually uses stops in an option. When in fact, an option by definition, allows you to define your risk. Yet they use stops, which is just like mind-blowing. Well, it looks like I lost video here. Isn't that kind of cool? Let's try this. All right. We got the video back. It's probably not going to last too long. I know what I did wrong. I had my camera unplugged for a while and it lost its battery power. I do have another battery over there. Hold on a sec. Hold right here.
Returning visitor.
Switching batteries. Oops. Let's see if that works. All right. We can edit all that out. All right, we've got the power going. We've got the new battery in. Here's the old battery. Yep, out of power. How do you get your risk to reward so high? We get our risk to reward because we employ a completely different approach to capturing this alpha and putting ourselves in a better situation. We control our profit line through a different type of strategy and through a different philosophy. Instead of treating it as a market neutral event, we treat every day as a directional event. And we maximize our profit-making potential by putting on a strategy that is designed to maximize your profit-making potential in a concentrated area, namely the butterfly. With the butterfly, and if we can place it far enough away from at the money, we can create an asymmetric risk to reward. But you may say, well, how do you get the kind of probability of profit? Well, that's the thing. That's, I guess, the secret sauce that we have here. We're still able to get the almost identical kind of probability of winning or probability of profiting as the other folks, but with a completely different risk to reward profile. A risk to reward profile that is literally 2 to 3 orders of magnitude more advantageous. And by using principles like probability of touch and also underlying analysis, where we do not use technical analysis at all, we analyze the volume structure or through volume profile. We are able to accurately gauge where price will be and where it is likely to go, and then use that information to then, and of course the butterfly, to model that idea in a asymmetric trade. And in a lot of ways, we're following the tenets that are laid down in the Black Swan investment philosophy. If you've ever read The Black Swan by Nassim Taleb, you'd understand what I'm saying. Or also his book called Skin in the Game, where he talks about the fundamentals of asymmetric wagers. So this is what we do. We use asymmetry, probability of touch, and some analysis magic. I guess you could call it our secret sauce, our discipline, to get a similar or better win rate with a risk to reward that is 3 orders of magnitude superior. So we use less capital, far less capital, 1/10 the capital, to go for 10 to 20 times more profit. Now, if you can comport those ideas, a lot of people are sitting there trying to take strategies like what everybody else is doing and improve them by, maybe 20, 30, 50%, and they think that they've accomplished something great. But we've improved it not by 10 or 20 or 30%, but by 3,000%. That's a game changer. And it's the reason why once people that are in those other services find out about this service, they take the trial, and then they find that they can use 1/10 or 1/20th the amount of money to make the same kind of money that they used, 10 or 20 or 30 times the money. Or within the trial, be able to make everything that they need to buy a full year's service before they even become members. They quickly do become members. That is the fundamental difference between 0-DTE.com and all the other 0 days to expiration services. Look, Scott Stewart appears to be a very knowledgeable guy and perhaps very experienced. I think he worked on the exchange, etc. And that's all great. Fine. But all of his experience that he's applying to this particular problem are wrong. All the other services, that what they're doing, applying this weirdness or incongruent strategies to a problem that does not deserve those strategies, they are also wrong. They're wrong in everything that they do. They are applying knowledge that doesn't belong in this arena. So everything that we do is predicated upon a lot of the principles, again, that are laid out in things that like the black swan and skin in the game, as well as anti-fragile systems that gain from disorder, which is a key component on how we treat volatility and how we gauge our risk to reward and our proportions, our sizing, etc. And also fooled by randomness. We have a fundamentally different view about how we treat the probabilities that are laid out in our platforms and what they are telling us, that are largely based on models of normal distribution, when in fact none of these markets ever exhibit a perfectly normal distribution. If they do, it's an anomaly. Yet this is what everybody else is gauging their statistical ideas around a normal distribution. So let me put it another way. We trade in the reality of the situation. They trade in a made-up fantasy of what they hope it will be. If you'd like to try out 0-DTE, our service here, trading the S&P, and we'll trade the S&P index, the SPX, or the E-minis. I didn't really go into the difference. I do have a podcast that I talked about this explicitly, but I feel that the E-mini S&P provides a dramatically better opportunity than the SPX. And see, this is another thing. This is another big difference, and one of the reasons why I put it up there. They trade the SPX for a very specific reason over the E-mini S&P futures contract, or options on those things. They trade the SPX because it has lower commissions, about 1/3 that of the E-mini S&P. But the reason why they do that is that the commissions that they endure compared to the teeny little bit of profit that they're going after is too big of a ratio. It kills them. So going from the E-mini to the SPX, even though the SPX is giving them far less capability in that it can only be traded during market hours, and it's a much larger contract, and it has no volume for doing any kind of analysis, they give up all of that and all the opportunity to get a slightly lower commission because they're going after a tiny, tiny little bit of profit. But because we're going after profit that is 10, 20 times what they're going after, or even 1,000 times what they're going after, that tiny difference in commission means nothing to us. And so therefore we can use the E-mini S&P and all of its benefits to exact a strategy that is based in reality, not fantasy. That is, again, the difference. So I've covered, well, I didn't really talk about 4 DTE versus 0 DTE, other than the fact that Scott Stewart uses 4 DTE because he's able to get a marginally better return on his risk. But still, it's laughable. The further out you go in terms of days to expiration, the more difficult it is to take advantage of the alpha or the edge that you have with the decaying premium, the exponentially decaying premium, because it really comes down to those last few hours. That's where your real edge is. And if you're not there, you're not taking advantage of what 0 DTE is all about. So these are the, well, on top of that, I forgot to mention that Scott Stewart talks about adjusting all of his trades, that he can hardly ever make one of his trades work unless he goes through machinations of adjusting the trade in order to put it in the right attitude in order to capture his meager profit. With what we do, there is no adjustment. None. We've never adjusted a trade. I don't believe we've ever adjusted a trade. Oh, look at all these questions. All right, so here's some other great things. Can your account work with a smaller account, say $10,000? As a matter of fact, it is uniquely superior to the SPX in working with small accounts when you're using the E-mini S&P because there is no pattern day trader rule. With the SPX, you're butting up against the pattern day trader rule every time you get over three trades, 3-day trades within a rolling 5-day period. With the E-mini S&P, you never encounter that because there is no pattern day trader rule. So therefore, you can trade with a much smaller account. In fact, you can start with our strategy with as little as $2,000 or whatever the lower limit that your broker will allow to add to your account in order to open a futures account. There are some brokers like Tradeovate where you can open up a futures account for as little as $500. Thinkorswim, I believe it's $2,000. With Interactive Broker, I believe it's $10,000. So you can open up an account with a very small amount of money and trade this strategy effectively and enjoy all of those things and a much freer way of attacking the problem in a realistic manner with small accounts. So yes, you can trade it with a small account. Oh my God, look at all these questions. I'm sorry I didn't get to all of them. In my case, I sell at the money iron butterfly. Usually I can get 1-to-1 risk to reward 1-to-2. If price breaches one of the breaks, I pay a debit and expand profit zone and roll the untested side. That's crazy. I wouldn't take less than a 1-to-5. As a matter of fact, if we don't get 1-to-5, we don't take the trade. And we've thrown away trades because we don't get that. However, we trade, 95% of the time, so we're able to put on our trades, and we're averaging 150 to 200% return on our risk, sometimes as much as 1,500% return. So whatever you're doing, Umar, you're doing it wrong. Anton Green says, hi, Ernie. Are you teaching volume profile techniques to your clients, or are they rely on analysis result that was done by you? I do have a volume profile course embedded into the service. The service itself is not an alert service. It's an educational service. I am here to teach you the strategy, the methods, and it's actually strategies, and our continuous improvement process, all designed around to make you or turn you into a professional trader. That is what this service is about. The alerts are a demonstration of all of those things. They just so happen to be so far superior to what anybody else is putting out there that I guess if you wanted to just come in and see if you could pick up this discretionary strategy, I have to make that point. It's a discretionary strategy, so it's skill-based. You need to develop skills in certain areas in order to make it all work. But once you do, and it's not that hard. Once you do, what you have learned is so vastly superior. It is, without a doubt, the most efficacious day trading strategy I have ever seen. Best return on risk, the easiest on your constitution because you're never anxiety ridden, ever. You can trade in complete calmness because you're never at risk of losing a whole boatload of money because you're taking such tiny risks. To use your strategy, I would need a broker that offers options on E-mini S&P. Yes, like Thinkorswim or Interactive Broker or Tastyworks or Tradeovate, and there's many others. Do you trade or perform? Let's see. Perform analysis using Thinkorswim or something else. I don't do the analysis in Thinkorswim. Oh, well, I do the options modeling in Thinkorswim, but we do the volume profile analysis in TradingView. It has tax benefits. Yeah, but so does the E-mini S&P. It has the exact same tax benefits as the SPX. And what those tax benefits are over, say, using the SPY or an ETF or a stock, is that with the SPX and the E-mini, your first 60% of profits are taxed at the long-term capital gains rate, which is generally lower than your nominal tax rate, and the next 40% are taxed at the nominal tax rate. So those are the tax advantages. But I'm not a tax attorney, so don't take my word for it. Aldo says, I read those books. It is funny and interesting Nassim Taleb was an options trader. Yes, in fact, we employ many of the tenets of what Nassim Taleb did. And in fact, he made what he calls fuck you money through his hedge funds and options trading, using a lot of these same kind of principles. Let's see, Chris, what are the tax implications of trading SPX futures? Well, as I just explained, there is some tax benefit to it. Could you please go over what platform do you recommend to have before joining your service? I prefer Thinkorswim. It is the most complete, probably one of the best options trading platforms out there, bar none. Trying to think, is there anything even close? Not really. I've used just about every platform there is. In Europe, so I'm researching what brokers. You can use Interactive Broker in Europe. Yeah, and their platform, yes, Interactive Broker platform does suck, but it is completely capable. All right, so we offer a 4-week trial. To take part in the trial, go to don't forget that dash, 0-dte.com/try. That's TRY. 0-dte.com/try. You'll have a 4-week trial. After you finish that trial, if you want to become a member, I will rebate the cost of the trial towards your membership. And the membership, by the way, in my view, and I think in the view of most people that take this course, is ridiculously small. Included in that membership is one-on-one coaching. Like I said, this is an educational service that teaches you strategies, methods, and a continuous improvement process, and everything that you need to become a professional trader. That's what this service is about. And the cost is, like I said, ridiculously low. Way lower than what Scott Stewart charges. I mean, gobs lower. So why would you choose a failing strategy and pay 6 times more for something that doesn't work? For something compared to something that absolutely works. I guarantee it. There are very few, there are some people that no matter what you do, you can't teach them how to be winners. They are out there. But I would say that most people that are in this service become successful very quickly. And those that don't, it takes a little longer. It's a discretionary service. There's a strategy. There's a lot to learn here, and we are mostly focused on that process. And once you develop that process, and you're in it to become a master of that process, and you will become successful. Let's see. To use your let's see, Ernie, do you trade and perform analysis? Okay, read that. Do you trade only during normal trading hours or pre-market? We trade pre-market as well. Most of our trades are actually put on prior to the market opening. As a matter of fact, today's trade was a great example. Now, the market went down. Last night, I talked about our analysis using volume profile and the market conditions, and I said if it didn't do this or this, that it's likely to come down, and we'd have to wait until the morning to see what the attitude is or what happened in the European market and whether or not it had the strength or not, if it was showing weakness. And it did show weakness. We went short with a butterfly that was way out of the money. You could have made as much as 800% on that trade. Many people may still be in that trade and holding on right to the very end. Let's see where we are. And if they are, they're making, yep, they could be making gobs of money right now. I got out a little early and I made about 350% of my money. Should have stayed in longer. It was a little, I had things to do, quite frankly. But today's trade was a big success. A typical day, about a 300% return for me. For others, some people get out with 150%. Some people get out with as much as 600% already. And if there are people in it currently, I know that they'll do well. How often should you be in front of the terminal? You know, it's a day trade. We trade 3 times a week. You don't have to be staring at the terminal, but you need to monitor it. You need to understand the trades move relatively slowly too. They come into position, they make profit, and then it's a matter of how long they're going to stay in the range of profitability and whether or not that premium decay is going to work in your favor, how long you want to stay in it. And then you make that judgment call and then get out with what you believe is going to be your best shot. I suppose it would be much better already having an account when joining your service. Yeah, I guess. So a lot of people join the service without an account. Some people wait until they do. Andrew says, I made 100% today, and I'm kind of scoffing at that. Yeah, I mean, you should have made more, quite frankly, but today was an unusual day. I made a relatively quick judgment on getting into the trade. I provided a staging environment for people to get in and say, okay, if things work out. But then all of a sudden it started to move, and I said, okay, we got to put the trade on. So some people may have been caught off guard with the signal, but it looks like about half the people in the service got into the trade. Some got stuck and maybe a little cold feet or whatever, weren't able to get in fast enough. That was unusual for today. Usually I provide hours and hours of upfront staging and getting ready and preparedness and waiting for specific things to happen before we get in. Today was a little bit different. Thanks, Andrew. The trial is for 4 weeks. And what's the price if I'd like to go in full? There's a yearly option, which is $785 for the year. If you do the trial, which ends up being about $80, you would subtract the trial from that. So it would end up being about $705 for the year. There's also a monthly option, which is $285 up front, which you also would deduct the trial cost from, and then it's $64 a month. About 70% of the people go with the yearly. They look at this as a long-term venture. They like what they have here. They like the teachings. They like the coaching, the mentoring, and they certainly like the winning. So most people go with the yearly. And in fact, even people that are in the monthly, a lot of them are switching over to the yearly. All right. Well, thank you very much for these questions. They were great. And our next episode will be on Wednesday, because that's another 0 DTE day. I want to thank you very much, and peace to you all. We'll see you next time. Get the button.